Hi, David Moore here with Tina Colson, Equity Advantage, 1031exchange.com, and we are here to provide some answers to those questions you may have out there. Tina, fire away.
Glad to be here, and I'm glad that you are viewing us today. So, David, my question would be, we have clients who own property where it's their residence, but also maybe they've got farmland with their residence and they're using that as timber income. Is there anything that we can do on the 1031 side that could help them with their tax gain if they sell this property?
Great question. I think you got to look back and understand, and I'm not going to talk about ages because I don't want to get anybody upset, but if we go back to 1997, we used to have a rule, Section 1034, that covered a home sale. And it had certain provisions there. If you're 55 or older, you had a one-time lifetime exclusion of $125,000 in gain. And, that got to the point in 97 where it didn't really seem to do that much. So it was replaced, that was 1034, it was replaced with Section 121, and we call that the universal exclusion. And that came in and gave you personally a $250,000 exclusion, married couple had a $500,000 exclusion. And to qualify for that, you had to have lived in the property for the aggregate of 2 out of the preceding 5 years. So in 97, that looked like a pretty good thing, 250 or 500. Now we go forward a number of years, 23 years, and 250 or 500 exclusion doesn't do much for a lot of people. So let me ask this, and I don't mean to put you on the spot, but let's say, and you and I have talked about it, you were talking about buying a plex, and let's say you buy a duplex and you live in half of it, and you've had it for the last 5 years. So what are you selling then?
I would say that my portion would be my personal residence, but I own the whole duplex, which then I also have my investment property.
So let's go
50-50.
Exactly. So let's look back at your question, and the question is, really, if we've got a larger property, and the example timber Tina gave me is that we're talking about a residence and we're talking about property that contain timber, okay? And timber in and of itself can be exchanged. I mean, depends on whether it's standing or severed. So standing timber's real, severed timber's personal property. Timber deed is real unless it contains a harvest provision. So in and of itself, the timber can be treated differently depending on what the situation is. But let's go back to the initial question was, I've got a property and it contains some of this stuff, but we'll just break it down to anybody with, let's say, a farmhouse and a working land, or that duplex, half owner occupied, half non-owner occupied. All those things, we're talking about a single asset with allocations made different directions. So the timber component, or let's say you're going to take the homestead portion, you're going to go Section 121 with it. You're going to take the balance of the property and go 1031 with it. Okay. So in our contracts, you're just going to read, we're doing an exchange of a portion of the asset. So what we've got to really do, and this is where your tax people are critical, and I just want to really instill upon people, I think the way the world's going, it's more and more complicated than ever before today. People have a tendency to go hire attorneys when they need them, but a CPA, a great CPA, you want to pay somebody you want to pay them for an answer. You don't want to pay them to learn, okay? So great tax people are critical in today's world, I think more so than ever before. So when we're looking at, let's say, that allocation, if it's a mirrored units on a duplex, it's pretty easy to make that allocation, right? 50-50. But if it's something else, how do you make those allocations? And that's where your tax people are going to come in. And my advice today is we're going to look at the asset. We're going to say, okay, what is the universal exclusion going to cover? Let's max out the exclusion. And then anything beyond that is going to go 1031. So our contracts we're going to do, they're just going to read, we're doing an exchange of a portion of that property. It's up to the taxpayer and their tax counsel to make that allocation. And hopefully at the end of the day, you've worked with us for a very short period of time now, just a couple months. But what is our job? Our job is to keep people's money theirs, yes. Right? And we say, what do we say? What's our saying?
They work hard to earn their money. We work hard to make it theirs and keep it theirs.
Exactly.
Yes.
So we're going to look at it. We're going to work with the taxpayer, their tax counsel, get those allocations made, and keep your money yours. And there's a variety of tools to do it. And Tina's question just really tees up one of those big ones. In situations like this, you really have to look at what you're selling, and not only look at maybe what you think it is, but what it could be. And people ask all the time to when should I contact you? When should I think about the exchange? I typically tell people when they buy something, but talk to your tax. When does the average person talk to their tax person? April 14th. Sorry, Dale. Anyway, but the bottom line is use your tax people for tax planning. If you're going to sell something, anytime you got a question, reach out to us. We always say, hey, we're the guys with the answers, right? So we want you to ask the questions. If it's something that we can help you with, what we're going to do, we're going to answer the question. We're going to arm you with information. Go talk to your tax people and work with them to keep your money yours and keep it growing. But great question.
Thank you.
Thanks for joining me today.
Thank you for your answers.
David Moore, Tina Colson, Equity Advantage, 1031exchange.com, IRA Advantage, IRAadvantage.com. Thank you.
Thank you.